Hi, everyone. Welcome back to the InvestPal podcast. My guest today is Jamie Shulman, the co-founder of Meriwether Group Capital, a private lending company focusing on growth capital to low and mid-market businesses. And prior to launching Meriwether, Jamie was actually the CEO of Northwest Bank. Jamie, thanks for coming on today.
Thanks, gentlemen. Really appreciate it.
Maybe just to kick things off, curious a little bit about if you could provide a little bit about you and your background and why the need to launch Meriwether Capital.
Sure. So, again, great to spend some time with you this morning. I'm a lifelong banker. That was my entire career. So prior to us launching a fund, I spent about 27 years in commercial banking with a couple large banks, a couple more community-sized, smaller banks, and that's all I know how to do is lend money. So it's not been our family business, and I've enjoyed doing that as a career. I'm here in Portland, Oregon, and I spent most of my life in the Pacific Northwest, so this is kind of my home. And so I had a great banking career along the way. Just kind of saw this need for businesses needed access to capital, but just kind of resided on the edges of what banks like to do.
Yeah.
And, by no means it made them a bad borrower. It just means, as most people know, banks have kind of the credit policy, the pricing policy, and, that's intentional. There's nothing at all wrong with that. And if you fit kind of within, the box, so to speak, it's a great experience. If you don't, it's tough. And frankly, there's businesses out there with, a story to be told, and each kind of dig in deeper. And these are credit-worthy businesses in many cases. We just kind of, weren't a fit for a bank. So that's exactly what we set out to do, is to work with businesses that were, for the most part, in high growth mode, were successful, and that they were, profitable, or at least EBITDA, cash flow positive, but just needed a little bit more access to capital, and a bank it just wasn't a good fit. I can dig in kind of deep on that, but at a high level, that's what we set out to do.
I am curious, I've spoke with actually a lot of venture debt companies in the past, and I'm curious to hear what your screening criteria is, especially around growth capital. Is it like the use of proceeds have to be centered around like marketing spend?
Yeah, so kind of who is our borrower? So, I think I'll start by saying, first of all, the kind that we offer, I try to be a little bit generic so we can be flexible around that, sort of private debt. The reality is we're kind of a hybrid between venture debt and mezzanine lending. That's kind of where we tend to fit in the best, and we're very flexible around that. So as long as we find a good deal, we'll structure the way it works for both us and for the borrower. So first of all, our borrowers are generally not startup, pre-profit, pre-revenue companies. These are ones where the public has said yes already. So like I said, they're profitable or at least cash flow positive. Typically in a high growth mode. So year over year revenue is growing at a significant clip. Not always, but in many cases, which is one of the reasons, banks get a little bit more challenged when they see a bank, company in high growth mode. Our source of capital usually fits into kind of one or two buckets. It's either for permanent working capital to kind of spur organic growth, or it's to do acquisitions. So we're not a long-term lender lending against real estate or equipment or an asset-based lender. We're very what I would call opportunistic. So we try to help the borrower identify an opportunity where they've already identified it. But hey, we want to grow a client relationship or get into a new product or geography and need some help doing it. And we want to get in there and solve that problem and then get out as fast as possible. So we're really kind of a bridge type lender. The average duration of our loans are about 18 months. So we're there to be really a short-term solution, which really kind of our repayment being either a more traditional bank would refinance the whole balance sheet, or maybe the company does an equity raise, or maybe even sell a company. Those are all kind of high-level exits for us. The businesses we work with, geographically, we can really go anywhere, although we definitely have a focus on the West Coast just because I'm here and I have a lot of contacts in banking and other kind of referral sources here. From an industry perspective, we're pretty much generalists. We avoid businesses where we don't easily understand how they make money, or ones where we just don't want to be on the front page of a newspaper. So, you can kind of think about what kind of businesses we avoid. frankly, we really like companies that make stuff. So they manufacture, wholesale, distribution, and then we have some service-based businesses as well. That's not at a high level, who we work with.
And on the actual facility side, is it a typical debt investment? Are you guys looking for like warrants or any sort of other sweeteners on the deal?
Yeah, so pretty much we're a one-trick pony. I've always kind of learned like figure out what you do well and do that, and don't do things you don't do well. So we avoid, things outside of really debt solutions. And then from time to time we do see warrants. The average loan we do, I mean, we market and do loans up to 5 million. And in reality, given kind of the nature of private credit, we're at the very lowest end of the spectrum, which we're very happy to be because I love working with these kinds of businesses, investors, frankly, and we just don't really have a lot of competitors. So, that's a good space to be. The average loan on our books is about 1.5 million. So our compensation and yield really comes from the coupon on the loan and then fees, which we typically get both as on the origination side and then the exit side. We typically don't have other sweeteners because the borrowers coming to us is really an alternative to raising equity.
Right.
And so if we're going to take an equity position, they might as well just, do an equity raise. And so we try to maximize our income there and, keep it again flexible for the borrower and be very consistent around how we structure our loans.
So taking a step back from this, obviously the credit space over the past 3 years has pivoted, I think, massively. Are you seeing that flow through on demand side where a lot of businesses aren't having access to traditional capital anymore and thus are coming to you looking for help?
Yeah. So, first of all, the kind of like my golf game, sometimes it's better to be lucky than good. We kind of got into private credit, picking the test rate that we wanted to do this, not because we saw a trend in the marketplace. And it seems like private credit is growing with popularity and, just based on kind of the universe of private debt out there, I definitely see that. So, borrowers are typically coming to us because they're wanting to grow and they're contemplating one of three options. Well, how do you fund that growth? So number one, the first place typically a borrower would do that would be from redeploying recurring cash flow. And most borrowers we work with are already doing that. So they're putting their income back into the business. So then there are really two choices. They could sell equity, which is more expensive, in my opinion, than debt and dilutive, meaning they're giving up control, or they could raise debt. And if they maybe maxed out their bank or their bank has maxed out them, then, we're kind of a very viable option for businesses in that situation. For us, demand is really strong. We try to do maybe 1 or 2 loans a month. And for every 1 or 2 we do, we look at probably 20 to 25.
Right.
So I get pretty much a call every day. And, I think that's somewhat a function of the environment. It's also somewhat a function of the kinds and sizes of loans we do. We do like to think we provide, exceptional customer service, which brings borrowers to us as well. And so maybe kind of mix all that stuff together, and it's a really strong environment to be a private credit lender, especially at the end of the spectrum where we play.
And are you noticing that these companies looking to raise capital are coming to you because they can't raise equity or because, the facilities available to them at a bank just aren't there anymore?
Yeah, it's sometimes would be my answer to that. I mean, some could raise equity, although it's really hard, I think, to do a minority raise, which is kind of what a lot of borrowers are coming to us in lieu of. It's hard to do. There's just not a lot of investment bankers that would take that on. And then it's kind of a friends and family trying to raise it yourself. And most borrowers are not there to be, raising equity. They have a product or service.
Yeah.
And so that's kind of what brings them, really to us. And so, that's why we tend to be a good fit is kind of in lieu of doing the equity raise.
Okay, and then I guess on the opposite end of the spectrum now, on the investor side, are you seeing a big influx of demand in terms of investors looking for income and looking for yield as a result coming to you?
Yeah, I'd say yes and no. I'd say we have a good portfolio of limited partners in our fund, mostly individuals and families looking for really kind of a yield upside. And we really structured our fund as really an income strategy. So we're all about preservation of capital and then a consistent recurring income stream. So we have a target return to our investors of 10% annually. We're super proud that we've beaten that return every quarter since inception of the fund, and we pay a distribution every quarter. And so, it can be good for those who are looking to complement maybe another, a fixed income portfolio that's maybe a little more conservative, or just a diversification tool away from another asset class. And we see a lot of people who come to us maybe moving away from real estate as an example, or maybe a business venture. And so, I think demand is good for our product, and I think we have a good track record. The reality is we're a young business too. We launched our fund 2 years ago. I definitely get the kind of too new, too small, response. And, I have a very thick skin about this. I mean, the irony is not lost on me that our borrowers are kind of in the same position that we are, and that they're trying to raise capital, and well, so are we. So we just said yes, more often. So we do have to compete with much larger players. I mean, we're 15 million in assets under management, which in the world of private credit, I like to say jokingly, we're the smallest pebble in a big and growing ocean. But we're super proud of what we do. We're very boutique, and I think we're all at the red carpet for both our investors and our borrowers. So I think we have a good offering for our investors, and it's just kind of continuing to get the name out and make sure we're partnering with the right types of investors who are interested in understanding what we do.
Yeah, I chat with a lot of advisors, a lot of people in the space, and it seems like there's a big channel towards the alternative market now, away from just the traditional equity and fixed income market, especially since things have started to be highly correlated with one another. Like they're supposed to be inversely correlated, and then that ended up bridging together during COVID. So I am seeing a lot of, especially like investment advisors, interested in access to alternatives now. So with that, is there, someone looking to get access to the private credit space? Just some tips on what like an advisor, what a retail investor could look for when scanning for different private credit vehicles?
Sure. So I'll give several thoughts on this. First of all, I think for any advisor that's wanting to work with a credit fund, or frankly, even another kind of alternative investment, I think it really starts by understanding the fund philosophy, the risk profile, and then it's really the fund manager. I think, that's where most decisions get made, and I'm not, putting myself on that pedestal, but, I'm primarily the one who's picking the loans we do, and that's the greatest point of risk for our business. And so understanding, what kind of loans are you doing, what could go wrong, how are you collateralizing or securing these positions, that's really important for an advisor who's looking to get into the space. Kind of taking a little bit of a step back, I do talk to a lot of advisors. Frankly, we made a number of investments from a technology standpoint to make it easier for advisors to have access to funds like ours, especially, we're a small one. We're not blasted all over the Wall Street Journal, et cetera. And so, making it easier is really important. And so for advisors to find us, it's becoming a little bit easier. That's when I say us, it's not just me, but other kind of smaller credit funds or other smaller alternatives, frankly. We partner, for example, with a company called Jamie Shulman Capital, based in Chicago, which is a fantastic company. They basically bring together advisors and alternative fund managers like us, and kind of a card catalog presentation where they then do diligence on us and can advocate for us. We work with another partner called Mammoth Technology, which is really a fintech partner of ours, where we make it really easy for advisors to recommend our fund, and then for the client to go online and do really a sub-doc process all electronically through DocuSign, and not to fill out a 100-page tomb of paper. And so that's kind of the stuff we're doing that I think are making it easier for advisors to be able to get access to research and then to fulfill, the client's goals, through us.
Okay, very interesting. Yeah, we had a conversation with Shana. She's very and very interesting individual. Um, on the macro lens, there's the market sentiment right now that interest rates are going to be cut at least a few times in the second half of this year. I'm curious on your opinion on that. Do you think we're in for higher rates for longer, or that the Fed's going to start cutting?
Yeah. We try to really operate our business kind of independent of where rates are going, and I'm not an economist. I think if I knew exactly the answer to that, we'd probably be having this conversation already off. But I'm not. So, here we are. Now, having said that, I think intuitively it seems like we're in a flat to likely falling rate environment, probably beginning this year. Just seeing that's kind of one of the data I see. We really set our pricing independent of the rate environment and based it solely on supply and demand. And right now, we have very limited supply, very high demand, and so you could get a sense of where we price, our loans, which we've seen steadily go up over the last 2 years. And even in a falling rate environment, we would only change our pricing philosophy if demand reduce, which I don't see happening. And frankly, in a falling rate environment, that's frankly more conducive to borrowing, which would likely spur a greater demand.
Right. So you would be of the view that a falling interest rate environment would actually be more beneficial to the private credit space?
I think across the whole spectrum, yes, to the extent that the lender's doing fixed rate loans.
Right.
So, intuitively, if they, price a loan at a fixed rate, and then during the duration of that loan rates fall, then, that's, beneficial because they're taking, they're getting the benefit of that, even though because they fixed it. In a floating rate environment, that would not be as beneficial in a fall, rates are going down. So it kind of depends on structure of these loans, and every lender's a little bit different.
Yeah, I'd be curious to see even on like the equity piece. Like I'm not sure what percentage of your on the demand side were customers who would have gone the equity road. But I know now even firsthand how difficult the equity markets are in general, where if we do see that trail off, it should bode well for the equity markets. And I wonder if you'd see like what percentage of the private credit customers going back to pursuing an equity raise instead of a debt facility.
Yeah, I think probably, I would just guess that probably 25% of the inquiries we get are wanting to do debt in lieu of equity. And that would be kind of right now. I think there's, especially for growing borrowers, I think intuitively they know that we can't select equity right now because we're in high growth mode. We have kind of fit characteristics of what an investment banker wants. But if we continue on this path, which debt will help us get to, then we're going to be very conducive for an equity raise in 1 to 2 years. That's a pretty common scenario. Either that or, hey, we're looking to sell the company in 1 to 2 years.
Yeah.
And that's, again, kind of why we structure our loans pretty short, is because those are pretty common conversations we have with our borrowers.
And would you say that your screening criteria, and I know you are affiliated with a private equity business as well, not direct, but is affiliated. Is there an overlap in terms of how you qualify an investment versus how a traditional private equity fund would qualify an investment?
Yeah, I've never run a PE firm, so I don't know what they would look at. I mean, I can kind of guess. I think they're looking for probably some similar characteristics, in that they want to get into a law or a borrower or a business where there's a viable exit strategy, big management team, recurring cash flow, diversified stream of revenue, etc. And they can see kind of how they get out of it. Private equity, those are pretty much structured, terms of 5 to 7 years, things like that. Our fund is actually evergreen, so it's open-ended, so we don't really have kind of an end date because we expect to continue to recycle the dollars as loans repaid, and we just make a new loan. And we have a lot of loan demand, so it's no problem, doing that. So I guess, we do look at things probably in a similar lens as an equity investor would. It's all about kind of the time frame and then the risk profile. We take a pretty holistic approach to credit that includes really traditional credit analysis. So we're looking at financial statements, balance sheets, looking at their, receivables, payables, etc. But then we're partnering that with really kind of the art of the business, the less the science, which is meeting on site with the management, talking to the owners, and most of our borrowers, talking to individual guarantors, and making sure they understand what they're doing, frankly, and how we're going to get repaid.
Right. I wonder, I'm not a private equity investor myself, but I do know I feel like they take like a hands-on approach. Is that like an area you take a hands-on approach to, or is it more set and forget it?
No, it's absolutely, well, first of all, it's very hands-on. We dive pretty deep with the borrower. I mean, we're kind of locking arms with them. I like to say, our underwriting doesn't stop when we book a loan. It goes all the way through until maturity of the loan. So we stay really close to these borrowers. Kind of on the side, we really try to fit within that circle of trusted advisors. So they're really leaning into us as someone who can help them, get to where they're going on their entrepreneurial path. So when we collect financials, for the most part monthly with each of our borrowers, we actually look at them. So we don't just file them away. And so, we know how the business is doing, all the way until our last payment with them.
Okay, very good. Yeah, I could imagine how beneficial that would be to the operator of that business.
Yeah, I mean, I think, considering the types of businesses we work with, a lot of times there may be, for example, someone has kind of a controller kind of helping with the finances. They're starting to grow, really needed to kind of upgrade that position to more of a CFO, but didn't really know where to go. And we have lots of contacts in, kind of that space with, temporary to full-time solutions, and we're able to make a recommendation. I mean, this isn't things that generate revenue for me, but I know it's the right thing to do. I know our borrowers appreciate it. And these things can all come full circle in life. And so if we can help with those kinds of things, then I think it's a win-win, for both the borrower and ourselves.
Yeah, very good. Yeah, well, I mean, it's helping guarantee your investment as well if you can stack the cards.
That too. That's bonus too.
So, Jamie, with that said, if there is anyone out there who's listening right now, what's the best way they can learn more about your fund and learn more about you and get in contact?
Sure. So thank you. So we have a website, meriwethergroupcapital.com. I'm on LinkedIn. The company has a LinkedIn page. I'm on LinkedIn as well. That's kind of our primary, media channel for sharing, good news about new borrowers and things we're up to. Yeah, it should be very easy to track me down if you kind of go through either of those portals, and I'd certainly appreciate it.
Yeah, we'll leave a link in the show notes as well for anyone interested in chatting with Jamie.
Awesome.
Jamie, thank you very much for coming on. Hopefully, I wish you the best of luck. Hopefully, we can stay connected. Maybe Investpal needs a loan from you in the future.
Perfect. Cameron, thank you so much. This was very fun.